Hello friends. If you are 65 or older in Canada, there are at least 6 bills you are legally allowed to stop paying in 2026. Added up, for a typical senior household, they are worth more than $3,600 a year. Real money staying in your pocket. And Service Canada will never phone to tell you about a single one. Stay with me all the way to number 6, because that is the one almost everyone gets completely backwards. People keep paying it every single paycheck, while they are literally collecting the very thing they are paying into. Number 1. Your property tax bill. This is the biggest fixed cost most seniors carry, and there are 2 legal ways to shrink it or skip it entirely. First, if you own your home in Ontario, there is the Senior Homeowners Property Tax Grant. It pays you back up to $500 a year against the property tax you already paid. You get the full $500 if you are single with net income of $35,000 or less, or a couple at $45,000 or less, and it phases out slowly above that. It drops by about 3.33 cents for every dollar over the limit, so even a couple at $48,000 still pockets a partial $400. Picture Margaret in Windsor, a widow living on $22,000 a year, paying $3,200 in property tax. She qualified for the full $500 every year, but for 3 years she never filed a return because her income was so low, and she quietly lost $1,500. Here is the mistake that costs people the money. You do not apply on a separate form. You claim it on the on-bin application that comes stapled inside your yearly tax return, so if you skip filing because you think your income is too low to bother, you throw away $500. Second, if you live in British Columbia or Alberta, you can defer the entire property tax bill. You legally postpone paying it until you sell the home or pass it on. On a Vancouver home with a $5,000 annual tax bill, that is $5,000 of cash flow freed up every single year. In BC, just know that on new deferrals starting in 2026, interest bills at prime plus 2%, while Alberta charges simple interest with nothing due until the title changes hands. This week, file your return and look up your province's deferral program by name. Number 2. The tax you pay every time you buy something. You cannot dodge sales tax at the till, but the government hands a big chunk of it back through the GST/HST credit. It is worth up to $519 a year for a single senior, up to $680 combined for a couple, and another $179 for each dependent child. It is completely tax-free, and it lands in your account 4 times a year, in July, October, January, and April, roughly $130 each quarter. Most people assume they have to apply. You do not. The Canada Revenue Agency decides automatically from your tax return, which means, once again, the only mistake that costs you this money is not filing. Take Harold, 71, who lived on $11,000 of OAS and figured there was no point filing at 0 taxable income. He skipped 4 years and canceled his own $2,000 in credits. When he finally filed all 4 back returns, the CRA paid him every missed quarter in one lump. If you have fallen behind, you can still file those back years, and the CRA will pay you the credits you were owed. File, even at 0 income, and this money starts arriving. Number 3. Your prescription drug bill. If you live in Ontario, the day after you turn 65, you are automatically enrolled in the Ontario Drug Benefit. No application, no income test to get in. Before 65, a senior on several medications can pay hundreds or thousands out of pocket. A common statin plus blood pressure combo alone runs over $1,200 a year at full retail. After 65, most pay a $100 deductible and then just $6.11 per prescription. Note the deductible resets every August 1st with the new program year, so filling before then wastes what you already paid. But here is the part people miss that is worth real money: the seniors co-payment program. If your net income is $25,000 or less as a single, or $41,500 or less as a couple, that $100 deductible disappears completely and your copay drops to about $2 a script. You have to ask for it. Enrollment in the base plan is automatic, but the low-income top-up is not. Consider Frank, on 8 medications, filling roughly 40 prescriptions a year. On the regular plan, he paid the $100 deductible plus $6 each, about $340. Once he enrolled in the co-payment program at $2 a script, his year cost $80. That is one phone call worth $260. Other provinces run their own senior drug plans with the same idea. Call your provincial drug program this week and ask if you qualify for the low-income copayment. And remember, number 6 is coming. The bill people keep paying while they are already collecting the exact benefit it funds. Hold that thought. Number 4. The tax bill on your own income. The moment you turn 65, the government gives you an extra tax break called the age amount, and most seniors never realize how big it is. For 2026, it shelters up to $9,208 of income, which knocks roughly $1,381 straight off your federal tax. You get the full amount if your net income is under about $46,000, and above that, it is clawed back 15 cents for every dollar. So at $60,000, you have already lost about $2,000 of that shelter, and it disappears near $106,000. The costly mistake here is income order. Because this credit fades as your income climbs, pulling a big lump sum out of a RRSP or RRIF in 1 year can quietly claw back part of your age amount. Take Doreen, who cashed out $20,000 from her RRSP in a single year to redo her roof. That spike pushed her past the threshold and shaved about $800 off her age amount credit. Had she pulled $10,000 across 2 years, she would have kept nearly all of it. Smooth your withdrawals across years instead of taking one giant hit. If someone else prepares your taxes, make sure the age amount is actually on line 30100. On a simple return, it is easy to leave off, and leaving it off is like handing back $1,300. Number 5. The tax on your pension income. On top of the age amount, there is the pension income amount. If you report eligible pension or annuity income, you can shelter up to $2,000 of it, worth about $300 in federal tax. Note carefully, plain OAS and CPP do not count for this one. Eligible pension income means things like a company pension, or, once you are 65, payments from a RRIF or an annuity. So here is the move most couples never make. Convert a small slice of an RRSP into a RRIF at 65, so you have eligible pension income to claim. Even converting $14,000 and drawing $2,000 out is enough to grab the full credit, and the RRIF must be based on age 65 or older to qualify. Picture Bill and Sheila. Bill draws a $30,000 pension. Sheila has almost none. By moving $14,000 of his pension income onto her return through splitting, and each claiming their own $2,000 pension credit, they cut their combined tax by about $1,400 and pulled Bill back under the OAS clawback line, which for 2026 starts near $91,000 of income. Then use pension income splitting. You can shift up to half of that eligible pension income onto your lower earning spouse's return. A retired couple doing this properly can cut their combined tax bill by well over $1,000, and it can even protect the OAS of the higher earner from the clawback. One conversation with the person who files your taxes unlocks this. Ask specifically about pension splitting before you file. Number 6, and this is the one people get completely backwards. If you are still working after 65 and already collecting your CPP retirement pension, you are almost certainly still having CPP contributions taken off every paycheck. Think about that. You are paying into the Canada Pension Plan while you are already cashing a CPP check. On $30,000 of employment income, that is roughly $1,700 a year coming off your pay at the 5.95% employee rate. Once you turn 65, those contributions are optional, and one form legally stops them, Form CPT 30. Take George, 68, working part-time at a hardware store for $25,000 a year while collecting CPP. He had $1,400 a year deducted for nothing until his daughter caught it. You fill out the CPT 30, hand a copy to your employer with proof you are collecting CPP, and the deductions stop the first day of the very next month. Just know you can only make this election once per calendar year, so time it early. At 70, they stop automatically no matter what. Here is the honest trade-off, because it matters. If you keep contributing, you earn a small post-retirement benefit that bumps your pension by roughly $40 to $50 a month of contributions over a full year. And even a full year of maximum contributions adds only about $45 a month for life. So if you plan to work many more years, running the numbers may favor continuing. But if you are working part-time, or only a year or two more, Stopping puts real cash back in your pocket now instead of drip-feeding it back to you pennies at a time later. Ask your payroll office for the CPT 30 form this week and decide on purpose. Do not let it happen by accident. So add it up. The property tax grant, the sales tax credit, cheaper prescriptions, the age amount, the pension credit, and stopping needless CPP for a typical 65-plus household that clears $3,600 a year, every year, completely legally. Your one action step this week is simple. File or update your tax return, even at zero income, because 4 of these 6 flow straight through it and nothing arrives until you do. If this helped you, subscribe and share it with someone over 65 you love. The ones who find out in time keep the money, and the ones who don't find out after it's gone.